All right, class. So now we're going to look at chapter 3, which is the end of our week 1 together. And we're going to be looking at financial statements and the ratio analysis. So in this chapter, we're going to look at learning goals of reviewing a company's financial statement, understanding who uses those financial ratios and how they use them, those using those ratios to analyze the firm's liquidity and activity. And we're going to discuss the relationship between that debt and financial leverage, as well as those ratios used to analyze the firm's debt. We're also going to use those ratios to analyze the firm's profitability and the market value. And then we're going to use a summary of those financial ratios and the DuPont system of analysis to perform a complete ratio analysis. This is going to be important for when you are doing your case, when those start coming up, because you're going to be looking at financial statements to look at those financial ratios. So initially, we have mandatory financial reporting of public companies. So we have the generally accepted accounting principles, or GAAP. They are authorized by the Financial Accounting Standards Board, or the FASB. And then we can look at the Sarbanes-Oxley Act of 2002. This was established by the Public Company Accounting Oversight Board, or the PCAOB. And then we can look at Forms 10-K, which is an annual report filed with the SEC that contains the company's audited financial statements in great detail, as well as other information about the business. There's the annual report that we look at. This reports, the companies provide prior to the annual stockholders meeting, containing basic financial info, as well as promotional materials designed to appeal to our current and prospective investors. There can be a letter to stockholders, which is the first element in an annual stockholders report, and the primary communication from management. It describes events the managers believe had the greatest effect on the firm's year, typically discusses their management philosophy, the corporate governance issues, and strategy and plans for the upcoming year. There are 4 key financial statements when we're looking at financial reports. The first one is obviously the income statement. This is a summary of the firm's operating results during a specific period. One thing in particular is the dividend per share, the DPS. This is the dollar amount of cash distributed during the period to each outstanding share of common stock that the corporation still holds. So, Target Corporation income statement example here. For fiscal years ended January 31 in 2020, 2019, and 2018. So the first line you see here, we have total revenue. Then we have, sorry, I'm just going to go ahead so that way we are looking at this together, and I'm going to use my highlighter here. So total revenue in 2020, we're looking at $78,112. In 2019, it was a little lower at $75,356, and in 2018, $72,714. So if we're looking at revenue, it looks like we've actually grown, which is great as a company. However, we have to take out cost of goods sold. So in 2020, we had 54,864. 2019, we had 53,299. And then in 2018, we had 51,125. So with that, we're going to take that out of revenue. We have to take out the cost of goods sold. So in 2018, we had a gross profit of $21,589. In 2019, we had $22,057. And then in 2020, we had $23,248. To make it simple, we know that these are in millions, so we're talking billions of dollars here. But with that, when we look at gross profit, we see, okay, it's not that much of a jump anymore because that cost of goods sold is getting taken out. Obviously, we spent a little bit more on cost of goods sold as the years progressed. With this, we also want to take out what are called operating expenses. So they could be our selling, general, and admin expenses, or our SGAs, and depreciation as well. So with that, in 2020, we had 16,233. In 2019, 15,723. And then in 18, we had 15,140. So relatively close for SAEs. And then depreciation wise, we're looking at 22,205, 22,204, and then 23,57. Again, this is depreciation. It could be on, the shelving or whatnot. It's our equipment, that kind of thing that we can look at depreciating. So our operating profit, our EBIT right here, if we look at 2018, it was 42,24, $45.10 in 2019, and then $46.58 in 2020. So with that, we can see that in 2018, we were doing well, once we took out those operating expenses. In 2019, we did go down a little bit. We had, some higher maybe cost of goods sold, some higher, the SGAs was substantially a little bit higher than in 2018, even though the depreciation was about the same. And then in 2020, we did make a definite leap. So we were up to 46.58, so 4 billion there in 2020. So the company has grown if we look at the 3-year period here. So, so then what we can do is we can look at, sorry about that. So then we can look at the interest expense. So again, we were looking at what was the operating profit or the EBIT there. Okay, that's the total revenue minus cost of goods sold and operating expenses. Now we can take a look at taking out some other things to see what did we provide to our stockholders? What is their bottom number? Because financially wise, we look like we're doing great. We're improving. So let's take a look. Our interest expense here was $477 in 2020, $461 in 2019, and $653 in 2018. We didn't have any other expenses, so that's fine. Then we need to add other income. So this could be, from some maybe accounts payables that came in or whatnot. So 21, 34 in 2019, and 65 in 2018. So our net profit before taxes was 4202 in 2020, 3683 in 2019, and 3636 in 2018. So from those numbers, we can see that we have grown. Our net profit before taxes has grown. So that's always a plus. But now let's take out our taxes. So we're taking out 921 in 2020, 746 in 2019, and 722 in 2018. As you can see, the more profit that you have, the more taxes that you do pay. So our net profit after taxes, or our net income now, is 3281 for 2020, 2937 for 2019, and then 2914 for 2018. Did we have any preferred stock dividends? If so, we'd have to take those out, but we do not have any of those. So our earnings available for our common stockholders are going to be the following net incomes, which is great because that's what we want to see. We want to see that we are providing a clear increase for our stockholders. So with that, we can see that we've improved 2018, 2019, and 2020. So then we look at our earnings per share of common stock, or our EPS squared, and that's 642 for 2020, 555 for 2019, and 533 for 2018. Our common stock dividend pricings, so 1345, 1347, and 1356. Again, 2020, 2019, and 2018. The DPS, the dividends per share, 263 in 2020, 255 in 2019, and 248 in 2018. And our outstanding shares, we have in millions, 511 million in 2020, 529 in 2019, and 547 in 2018, which means that's going down, which means we have more investors. More people have bought our common stock, which is a benefit to us as Target. So our stock price at the end of the fiscal year, huge difference. If you look at 2018, you're looking at $75, but in 2020, it rose to $110.74. So that's substantial. And there's a little calculation divot down here on how to calculate the earnings per share of common stock. It's calculated by taking the earnings available for common stockholders by the number of shares outstanding. So again, we went through the number of shares outstanding. You take that, divide the earnings available to get that earnings per share of common stock. Another example that we have, Jan and John Smith, a mid-30s married couple with no kids. they prepared a personal income and expense statement, which is very similar to our corporate income statement. A condensed version is on the screen. So we have their income and expense statement. So their income, their salaries together, they make $91,500 total. They receive interest of $195. That could be off of CDs, savings accounts, whatever they might have their money into. And then they also receive dividends. So they must own some stocks. So they receive dividends of $120. So their total income, adding all of that together, is $91,815. Now, they do have more expenses throughout the year. So total all year in mortgage, they pay $11,500. They have auto loans of $42.80, utility bills of $31.80, home repairs and maintenance of $10.50, food of $82.35. Car expense could be gas maintenance, your yearly inspections, $54.50, and healthcare and insurance is $31.50. They also pay for clothes, shoes, accessories of $27.45. They pay about $13.80 in insurance. They pay $36,600 in taxes. They make payments to appliances and furniture of $12.50. Recreation and entertainment could be going out, golfing, whatever else, $45.75. Tuition and books for Jan costs $38.30, and personal care and other items total $9.15. So their total expenses, adding all of those expenses up, is $88,140. So their cash surplus or deficit, you're going to take $91,885 and subtract the expenses of $88,140 to get a cash surplus of $36,755 at the end of the year. So during the year, they had a total income $91,815, total expenses of $88,140, which left them again with that cash surplus of $36,755. They can save and invest that surplus. It represents about 4% of their total income. And most financial advisors are going to suggest a much higher savings rate, so they may want to take a hard look to see where they can cut some of those expenses. So again, we had the income statement. Now we're going to look at the balance sheet. This is a summary of their financial position at a given point in time. It lists their current assets, which are short-term, expected to be converted into cash within the next year. Their current liabilities, those are short-term liabilities expected to be paid within 1 year. Their long-term debt, which is not due in the current year, but there's still debt for payment out there. Their paid-in capital in excess of par, which are proceeds in excess of the par value received from original sale of common stock, as well as the retained earnings, which is the cumulative total of all earnings, net dividends that they've received and reinvested in the firm since their inception. So again, if we're looking at Target, we looked at, their income statement. So here's their balance sheet. So their assets. We have cash, which is a huge one. We have marketable securities, which again are their stocks, their bonds. We have accounts receivable. We have inventories, maybe any other current assets. So their total current assets, again, easily liquidated into cash within the year. We can see here in 2020 was 12.9, 2019 was 12.5, and then again in 2018 was also 12.5. They did go down a little bit in 2019, but they also have property, plant, and equipment, or PPE. So again, that's based off of their, storage warehouses, anything that they might have in those. So that has increased, which could be they built something new. Valuation on a plant came back, it's a little bit higher. We also have to take out accumulated depreciation. So what we're going to do is we're going to take that 45 and subtract the 19. We're going to take the 44 and subtract the 18, 42 and subtract the 18 as well. There are also other long-term assets, which usually are not listed on the balance sheet, but will be found in like a statement schedule later on saying this was part of the balance sheet here. So other assets are there. So then we have total long-term assets. So then we have these following values. And then what you're going to do for total assets is you're going to take this 12 and you're going to take this 29 and you're going to add them together to find the total assets for those years, if that makes sense. And clear all of those. Then we can look at the liabilities and the stockholders' equity section. And again, these are the accounting balance sheet here. So they'll list out accounts payable, any other current liabilities, and current portion of long-term debt. that they are going to be paying this year. So those are all the current liabilities if you total all those up. Then we're going to have the total long-term debt that they still have out there and other long-term liabilities that they're not going to be taking care of this year. Those are added together. So then when you have your total long-term, you're going to take your total current or your short-term liabilities, and you're going to add in those long-term liabilities. So that's going to give you the total liabilities of 30,946 in 2020, 29 in 2019, and then 28 in 2018. Then we're going to take a look at the owners' section. Okay, so that's where we're going to see the preferred stock, the common stock, any paid in capital, any retained earnings. That's where we're going to find that section. So preferred stock, they had none. Common stock, they did have some, so they listed out. The paid in capital excess of par on that common stock is listed out, as well as the retained earnings since the beginning of their operation. Then we're going to take out any accumulated comprehensive losses and treasury stocks that we still hold. Once you have that, then you add everything together and you're going to get your stockholders' equity. So in 2020, it was 11.8. In 2019, it was 11.2. And then in 2018, it was 11.6. Then you're going to add that to the total liabilities section that you saw earlier. And that equals in 2020, 42,779. Now, we need to make sure that total liabilities and stockholders' equity equal our assets, right? So if we take a look, we have 42,779 in 2020, same for liabilities and equity. 41,290 in 2019, 41,290. And then in 2018, assets were 40,303. And then we see here liabilities and stockholders' equity was the same. So that all pans out. So we have an equal balance sheet here. Personally, we can look at the following balance sheet for, again, Jan and John Smith, the couple introduced earlier, who are married in their mid-30s, have no kids. It's similar to the corporate balance sheet. So again, it's going to be a smaller scale because they're not going to have that much. But if you look at the cash on hand, these are their assets. Again, we have short-term listed first and then long-term after that. So cash on hand, 90. Checking accounts, 575. Savings account, 760. Money market funds, 800. Again, liquid assets of 2225 is what that total. Then we can take a look at their liabilities and net worth. I will say that they will have stocks and bonds of that 2250. That's where those dividends that we saw in their income statement came from. So they are getting dividends off of those stocks and bonds. Those are long-term. They are not short-term. Usually it takes a little bit longer to liquidate those. That's why they're listed separately. Liabilities and net worth. So we have credit card balances of 665, utility bills of 265, medical bills of 75, other current liabilities of 45. So their total current liabilities are at 1050. And then they also have their real estate mortgage at 120,000. So they have total assets. Again, this is going to break down a lot more for their mutual funds, retirement funds, investments, real estate, cars. If we take a look at all their assets, even though they have that mortgage loan, we can take a look at their assets and see what that totals out to. So we have mutual funds, 1,500, retirement funds on an IRA of 2,000. So their total investments are equal to 5,750. Here we have 3,500, but remember we also have the stocks and bonds from over here, the 2,250. So we need to add those together. Real estate, that's how much their house is worth, 180,000. So you know that they owe 120 on it, but it's worth 180,000. They have 34,000 worth of cars if they wanted to sell it. Household furnishings of 3,700, jewelry and artwork of 1,500. So their total personal property that they have available to them, real estate, cars, household furnishings, and their jewelry and artwork is 219,200. So if we were to add that to the 5,750, as well as the 2,225 from their assets, liquidable assets, we have 22,175. Now, again, continuing on with their liabilities and net worth column. So we saw their total current liabilities equal 1050. They have that real estate mortgage. So that is a liability against them. That's debt against them of 120. They also have auto loans out of 14,250, education loans of 13,800, personal loan of 4,000, a furniture loan of 800. So adding all those long-term liabilities up, we get 152,850. Now add that to that current liability of 1050 and you get 15,300. If that makes sense, let me know. Now, with that, their net worth is going to be the difference of their total assets and total liabilities. So if we take a look at that, we're going to take out the 153.9 out of their total assets, and that's a difference of 73,275. So you're going to take that 73,275 and add it to the 153.9 to get total liabilities and net worth of 227,175, which equals the total assets column. So again, down at the bottom, it says total assets of 227,175, total liabilities of 153.9. So again, that personal net worth is a difference between those two. So if they were to go ahead and sell the cars, sell the house, sell their household furnishings, their jewelry, their artwork, sell off those mutual funds, those long-term investments, those items, they have cash in the bank as well. If they were to sell off everything, it would take care of the auto loans, the mortgage, the educational loans, the personal loans, the furniture loans, and they'd be left with 73,275 of what they have that they own and can take away, just get up and go. So that's why that's their net worth. The next statement is the statement of retained earnings. So this is going to reconcile that net income earned during a given year and any cash dividends paid with the change in retained earnings between the start and the end of that year. An abbreviated form of that is the statement of stockholders' equity. So again, we're going to look at target. So retained earnings balance at the beginning of the year. We're going to add in any net profits after taxes. That was from what we found in the income statement. And then we're going to subtract out any cash dividends paid for the year, any preferred stock, any common stock, and any stock repurchases. So our retained earnings balance at the end of the year equals 6433, 6017 in 2019, and 6495 in 2018. So that's how they came up with those figures for the balance sheet. So if we were to go back into the balance sheet for Target, you can see here is how they came up with those figures. So that's where the retained earnings come into play right here. So that's how they came up with those figures. If that makes sense, great. If it doesn't make sense, please feel free to shoot me a message. But that is how they came up with the retained earnings. And this is just a small little tiny statement. Again, that's literally all it's focusing on. And the last statement that we're going to talk about is the statement of cash flows. This is a summary of the firm's operating, investment, and financing cash flows and reconciles them with changes in cash and marketable securities during that specific period. So again, looking at Target for 2018 to 2020, the cash flow. So net profit after taxes, which is also known as our net income. You'll see that there. That's what we got from the income statement. Then we're going to take depreciation, okay? We're going to add that in. Then we're going to take out any changes in accounts receivable. So obviously it went down, which is great because that means people are paying their bills towards Target. The change in inventory. So any reduction would mean that the inventories are lessening a lot that year. So as we can see, 2019 was a big year. It could be because the pandemic was just starting at that point in time, and a lot of people weren't buying items. So inventory went way down. They just decided, no, we're not, restocking shelves, that kind of thing. Other current assets, we can see that again, it went down in 2018 and 2019. Accounts payable. In 2018, we had 1425. So we owed a lot more to people. As you can see in 2020, it didn't go up as dramatic as it did in 2018 and 2019. Change in accrued and other current liabilities. That value is also added in. And then the change in other unreported operating items. So you're going to total all of that together, and you're going to see the cash provided by those operating activities. So you can see 2020 was a big spending year, then followed by 2018, and then by 2019. Then we're going to look at the cash flow from investment activities. So again, any change in property, plant, and equipment, or PPE. So this was the gross changes. So it could be we sold off a place maybe. So our PPE went down. Maybe something was valued a little bit lower, We also look at the change in other long-term assets and other unreported investment items. So that again is all added together, and you're going to come up with negatives because if there's negative cash flow, then it's going to be negatively added together, if that makes sense. And then we're going to look at the cash flow from financing activities. So this is going to be the change in long-term debt. What was the change of that? The change in long-term debt, was it positive or negative? The change from other long-term liabilities, the change in total stockholders' equity, dividends paid out, and changes in other unreported financing items are also going to be on this statement. Again, you're adding all of those columns together. And then you're going to take a look at the net change in cash and marketable securities. So again, if you take a look at the cash provided by the operating activities of what's going on a daily basis, and then you take out the cash flow from investments and then the financing, it'll leave you with that change in cash and marketable securities. Sometimes it's going to be positive, sometimes it's going to be negative. There are also notes to the financial statements, like I said earlier, where it might be relevant accounts to the statements. They provide the detailed information on accounting policies, procedures, calculations, and transactions underlying those entries in the financial statements. So you can get more detail in the notes, what those other long-term liabilities might be, what those other, unreported equity statements are, whatnot like that. So you can find all of that in the notes section. Then they have consolidating international financial statements. So the FAS standard number 52 mandates that U.S. companies translate their foreign currency denominated assets and liabilities into U.S. dollars for consolidation with the parent company's financial statements. So there's a current rate or translation method that's a technique used by U.S. companies to translate that foreign currency denomination assets and liabilities into U.S. dollars in order to compare and consolidate with the parent company's financial statement. And they use the year-end or current exchange rate as well. So now we're going to get into the fun of using those financial ratios. So the ratio analysis is a method for using to evaluate financial performance on a relative basis for many corporations. The required inputs come from that income statement and balance sheet. So it's very important that the income statement and balance sheets are correct. The interested parties in looking at a ratio analysis would be shareholders, creditors, as well as management. There are different types of ratio comparisons. There's the cross-sectional analysis. This compares different firms' financial ratios at the same point in time. You're going to be doing one of these for your final project for whatever companies that you're going to be selecting when you're going to evaluate between the different firms' financial ratios. So you're going to compare the firm's ratio with the other firms in its industry or maybe with industry averages. So again, for the final project, it might be beneficial to choose a few companies, especially when you get to part 2 of the final project, that are within the same industry as your initial selection. You also can look at benchmarking, which is a cross-sectional analysis where the ratios are compared to those of their competitors or with other firms that it wishes to emulate or copy or be part of that higher end competitor. So, for example, these are financial ratios for select firms and their industry average values. So we're looking at building materials. We look at Lowe's, Home Depot, and Builders First Source. So, for example, inventory turnover is quite high at Builders First Source, which is great. The industry average, though, is 12.6. And you can see that Lowe's has a low inventory turnover, which means that they're not selling a whole lot compared to the industry average. But they have a higher net profit on margin than the industry does. They're at 5.9% rather than 5.3%. You'll see Home Depot has a huge net profit margin at 10.2% coming in, and the return on their total assets is astronomically high at 23.5%. And that could be due to the, quick ratio that they have. Their debt ratio is also relatively higher. So they could be just, taking on a little bit more debt and just turning that over real quick to their shareholders. it's important to look at their financial statements to get a whole picture. But if you look at like the computer industry here, Apple, Cisco, and IBM, you can see that the inventory turnover is lower for the computers, at 14.6, whereas Apple's at the high end of 36.5%. But you can also see that their net profit is 21.5%. So something has got to be said that, there's that larger net profit and return on total assets, even though they might have a higher inventory. So again, if you look at the debt to equity ratio and the debt ratio, that might give you some more insight too in comparison to the rest of the industry competitors. We can look at eating and drinking, Chipotle, Texas Roadhouse, Wendy's, or merchandise stores like Dillard's, Nordstrom, Target, and even Walmart. So you can see like all the difference that you can uh, pick apart and compare and contrast. But it's important to also look at the financial statements to figure out where they came up with these and a little bit more background of the story behind what they're doing to make them either profitable or not profitable. So it's important to look at everything. But this is a great financial ratio scenario summary for a lot of places that we're looking at in the industries. And this was, I want to say 2022, so it's relatively uh, in market with what today's terms are. So here's an example. Early in the year, Mary Boyle, the chief financial analyst at Caldwell Manufacturing, a producer of heat exchangers, gathered data on the firm's financial performance during the previous year. She calculated a variety of ratios and obtained the industry averages. She was especially interested in inventory turnover, which reflects the speed where the firm moves its inventory from raw materials through production into finished goods and to the consumer as a completed sale. Generally, analysts like to see higher values of this ratio because they indicate quick turnover of inventory, more efficient inventory management. So their Caldwell Manufacturing's inventory turnover for the year just ended in the industry average turnover were as follows. So Caldwell had 14.8. The industry average is 9.7. So they are overperforming, have a quicker turnover of inventory. Initially, Mary believed that the firm managed the inventory much better than the average firm. Their turnover was nearly 53% faster than an industry average. However, she realized that a high inventory turnover could be a sign that the firm is not holding enough inventory as well. So the consequence of low inventory could be excessive stockouts, insufficient inventory to meet the customer's needs. So discussions with people in the manufacturing and marketing departments did in fact uncover that that was exactly the problem. So again, it's all great in the scenarios, that we were looking at in the chart earlier. But sometimes there is a problem as to why it is such a higher turnover. Inventories of raw materials were extremely low, resulting in numerous production delays that hindered the firm's ability to meet the demand and resulted in disgruntled customers and lost sales. A ratio that initially appeared to reflect extremely efficient inventory management was actually a symptom of a major problem. So we can use financial ratios in a time series analysis as well, where we're evaluating the firm's financial performance over time using a financial ratio analysis. We can look at the combined analysis, which combines the cross-sectional that we talked about earlier, where it's a comparison, and the time series over a period of time. So here's an example of a combined analysis. This is the net profit margin for American Airlines versus the industry average. So the industry average is the red line and American Airlines is the blue line. So we can see how the net profit for American Airlines performs against the industry average here. There is some caution about using ratio analysis though. Ratios reveal large deviations from the norm. They indicate a possibility of a problem. A single ratio doesn't necessarily provide sufficient information to judge the overall performance of the firm. Like I said, it's important to take a look at all of the financial statements. The ratios should be compared using the calculated information from the financial statements dated at the same point in time during the year. So don't see something from March 2023 and use something from a different company of June of 2024. They need to be at the same point in time. It's preferable to use audited financial statements because then it's been audited by a third party, verified as accurate. The financial data should be developed in the same way, and results can be distorted by inflation. We can look at liquidity ratios. So liquidity, the ability to satisfy those short-term obligations as they come true. So one of the ratios that we'll be using is called the current ratio, where we take current assets and divide current liabilities. It is measured, it's a measure of liquidity. You're going to see this a lot for current ratio. And if you glance back at the first column in table 3.5, which showed the current ratio for a variety of companies and industries. So we were talking about, Apple, Lowe's, Home Depot, the food places. Notice that the industry with the highest current ratio or the most liquidity is computers. It's an industry that's quite sensitive to business cycle swings. The current ratio for that industry is 2.0, indicating that the typical firm has twice as much value in current assets as it does in current liabilities. The individual firms highlighted from that industry operate the current ratios that are less than the industry average. So does this ratio mean that those firms have a liquidity problem? No, not necessarily. Large enterprises generally have well-established relationships with banks that can provide lines of credit and other short-term loan products in the event that the firm needs that liquidity. Smaller firms may not have that same access to credit and therefore tend to operate with that more liquidity. Individuals, like corporations, can also use financial ratios to analyze and monitor their performance. Typically, they're calculated using a personal income and expense statement and the personal balance sheet for the period of concern. So we're going to look at Jan and John Smith's liquidity ratio for calendar year 2021. So the personal liquidity ratio is calculated by dividing the total liquid assets by the total current debt. It indicates the percentage of annual debt obligations that that individual can meet using their current liquid assets. So again, their total liquid assets were $22.25. Their total current debts are $18,080. Their total current liabilities of $10.50 plus their mortgage payments of $11.5 and auto payments of $42.80, and then those appliance and furniture payments of $12.50. So let's put that into the ratio formula. So we're going to get 2225 divided by the 18,080, and we're going to get 12.3%. So that indicates that they can only cover about 12% of their existing one-year debt obligations with their current liquid assets. So they're planned to meet the debt obligations from their income, but the ratio suggests that their liquid funds don't provide a large cushion for them. So one of the goals they need to do is build up a larger fund of liquid assets to meet unexpected expenses. One of the things we can look at is the quick ratio or the acid test ratio. This is current assets minus current liabilities over current liabilities. So it's dividing your current assets minus current liabilities over your current liabilities. If we look at table 3.5, again, examining those current and quick ratios for different firms and industries, we're going to see that Apple has a current ratio of 1.6 and a quick ratio that is nearly identical at 1.4. Most of the companies in the other tables have a large gap between their current and quick ratios. So Nordstrom in the clothing department, for example, they've got a quick ratio of 0.3. That's just 1/3 of its current ratio of 0.9. Why do we think there's a reason for the difference? So first of all, Apple relies primarily on contract manufacturers to make their products. So it holds no or little inventory while the devices are being made. Second, Apple's popularity products means that the inventory doesn't sit on a retail store shelf very long. All it takes is a trip to your local Home Depot or Lowe's store to see that the business model in this industry requires massive investment in inventory, which implies that the quick ratio is going to be much less than the current ratio for building material firms. We can also look at activity ratios. These measure the speed where various accounts are converted into sales or cash. One of these ways is through the inventory turnover ratio, where we look at cost of goods sold and divide by inventory. So it measures the activity or the liquidity of a firm's inventory. One thing we can also look at is the average age of inventory, which is taking 365 days and divide it by the inventory turnover ratio. And this is the average number of days sales in inventory. We can look at the average collection period, which is our accounts receivable divided by our average sales per day, or accounts receivable divided by our annual sales divided by 365. It's the amount of time needed to collect accounts receivable. I use this a lot in insurance because I have a lot of people who have renewing policies, and we want to make sure that we're collecting their premiums in a safe and efficient time before they get into that pending cancel status. So I take a look at the average collection period a lot. It's something that I look into every day to make sure that we are performing well and under, the percentage that is required by my home office. So in table 3.5, the vast differences across industries of the average collection periods, if we take a look at that. Companies in the building materials, eating and drinking, and merchandise store collect in just a few days, whereas like firms in the computer industry take a month or two to collect on their sales. It's because they serve very different customers. So grocery and retail stores serve individuals who are paying in cash using credit cards, which to the store are basically cash. Computer manufacturers sell to retail chains, businesses, other large organizations that negotiate those agreements, allowing them to pay well after the sale is made. Usually those are your like net 15, net 30 invoices. So with that, we can look at the average payment method, which is accounts payable divided by average purchases per day, or the accounts payable divided by the annual purchases divided by 365. This is the amount of time needed to pay accounts payable. One other thing to look at here is the total asset turnover, which are our sales divided by total assets. It indicates the efficiency that our firm uses to generate sales with our assets. So Target turns over its assets a little less than twice each year, but some companies turn over assets faster. Consider like the grocery industry, like Kroger. In a typical year, Kroger's asset turnover is above 3.0. That's because while Kroger and Target both sell perishable groceries, the percentage of Kroger sales are going to be accounted for that's much higher than in the case of Target because they have to sell much of their inventory fast or they risk losing it entirely. We can look at debt ratios. That's financial leverage. It refers to the degree to which a firm is using debt financing and the effects of that debt financing. The degree of indebtedness, that's the ratio that measures the amount of debt relative to other significant balance sheet amounts. The ability to repay debt coverage ratios. Those measure a firm's ability to make required debt payments and pay other fixed charges like your lease payments. They're also called coverage ratios. They assess whether the company can service their debts or make their payments on time. So here's an example. Patty Akers is incorporating her new business. After much analysis, she determines that an initial investment of $50,000, which is $20,000 in current assets and $30,000 in fixed assets, is necessary. These funds can be obtained in one of two ways. The first is the no debt plan, under which she would invest the full $50,000 without borrowing. The other alternative, the debt plan, involves investing $25,000 and borrowing the balance of $25,000 at a 6% annual interest rate. She expects $30,000 in sales, $18,000 in operating expenses, and a 21% tax rate. Remember, corporations at 21%. Projected balance sheets and income statements associated with the two plans appear in Table 3.6, which we will see here. The no debt plan results in after-tax profits of $9,480, which represents a 19% rate of return on her $50,000 investment. The debt plan results in $8,295 of after-tax profits, which represents 33.2% rate of return on her investment of $25,000. The debt plan provides Patty with a higher rate of return, but it's also got higher risk because the annual $1,500 of interest has to be paid whether her business is profitable or not. So here's her financial statement associated with her alternatives. So if we look at the no debt plan, we can see how they came up with the 19%. So the return on equity would be the net profit after taxes of $94.80 and taking that and dividing it by her initial investment of the $50,000. The debt plan, again, remember, she only invests $25,000. So we're going to take the net profit after taxes, the $8,295, and divide it by that $25,000. And that's where we get the 33.2%. With the debt ratio, we're looking at total liabilities divided by total assets. It's measuring the proportion of total assets financed by the firm's creditors. We also need to look at the debt to equity ratio. Total liabilities divided by the common stock equity. It's going to measure the relative proportion of liabilities and common stock equity used to finance that firm's total assets. Another thing we can look at would be the times interest earned ratio, which are the earnings before interest and taxes, or EBIT, divided by interest. So it measures the firm's ability to make contractual interest payments. It's sometimes called the interest coverage ratio. We can also look at the fixed payment coverage ratio. So this is going to measure the firm's ability to meet all fixed payment obligations. And with that, we need to look at EBIT plus any lease payments and divide that by the interest plus the lease payments plus any principal plus preferred stock dividends. And there's a calculation where we're going to take that and multiply it by 1 divided 1 minus T, which is usually the time. We can look at common size income statements where we're going to be looking at each item expressed as a percentage of sales. So here is Target's common size income. So again, this is based on that relative item based on sales. So we're really taking everything and dividing it by that total revenue to see what percentage of that revenue or sales each of those items in the income statement is percentage-wise costing the company. So with that, we can look at the gross profit margin. So sales minus cost of goods sold divided by sales, which equals gross profit divided by sales. So it measures the percentage of each sales dollar remaining after the firm has paid for its goods. We also need to take a look at the operating profit margin, which is the operating profit divided by sales. So it's going to measure the percentage of each sales dollar remaining after all of the costs and expenses other than interest, taxes, and preferred stock dividends are deducted. They are the pure profits earned on each sales dollar. So here's Apple's gross margin and share of the market for smartphones. So you can see the smartphone market share as well as the gross margin. Another ratio that we can look at for profitability is the net profit margin. This is where we have earnings available for common stockholders divided by sales. It's going to measure each sales dollar remaining after all the costs and expenses, including interest, taxes, and preferred stock dividends, have been deducted. And that's going to be a percentage. We can look at earnings per share, or EPS. This is the earnings available for common stockholders divided by the number of outstanding common shares. So it's going to represent $1 earned during the period on behalf of each outstanding share. The return on total assets, or the ROA. This is earnings available for our common stockholders divided by the total assets. It's going to measure the effectiveness of management and generating that profit with its available assets. It's also called the return on investment, or ROI. We can also look at the return on equity. So this is earnings available for common stockholders divided by that common stock equity. It's going to measure that return for their investment in the firm. With market ratios, these are going to relate a firm's market value measured by the current share price to certain accounting values. So one of the things that we're going to look at, especially in your final project, is the PE ratio, the price earnings ratio. This is the market share per share of common stock divided by the earnings per share. It's going to measure the amount that investors are willing to pay for each dollar of that firm's earnings. So the higher the PE ratio, the greater the investor confidence. So here's the average PE ratio for U.S. stocks. So as you can see here, we had a long average, the long run average for PE was 21.3 is how it is. So you can see in 2008 there where it was super high, super confident, that was the real estate, and then boom, the house boom, and then it dropped. As you can see, it's coming back up again. So investors are having more, interest and willing to invest in the stock market again. But you can see how, something like that can help bring it right down and just drop the confidence in investing. So we can see that it has gone up. There is a steady increase since then. I want to say the pandemic was that little divot, probably right about here where it dropped again, that confidence dropped again. But then you can see that we have come up and out of that again. Some other market ratios are the market book ratio, where we're looking at the book value per share of common stock. This is the total common stock equity divided by that outstanding common stock. The market book ratio, or the MB ratio, is the market price divided by the book value. So, and that's of common stock. So this is going to tell the investors how their performance is comparing to the market price of the stock to its book value. So we can look at a complete ratio analysis, the summary of Target's financial condition. If we take a look of what we've looked at this entire time regarding Target, liquidity, their position was relatively stable over this period, a slight increase in 2020. Their activity, they're managing their assets, their liabilities reasonably well. The total asset turnover was rock steady from 2018 to 2020. Their debt, it did increase slightly from 2018 to 19 before moving back a bit in 2020. So they're generating enough cash flow to cover their interest payments, though leverage does increase their risk profile. Profitability, they were profitable from 2018 to 2020 by all measures and were more profitable than Walmart. Compared to their industry average, it exceeded on some measures and tailed on some others. With the market, both the PE and MB ratios rose sharply in 2020, reflecting an upswing in stock prices generally over that period. So Target's PE ratio was below that of the average stock, but it's not surprising given their size and the industry that they're in. So overall, their financial position was sound in absolute terms as well as relative to their key competitors. Now let's take a look at the DuPont system of analysis. It's used to dissect the firm's financial statements and assess their financial condition. So if we look at the formula, it's going to multiply the firm's net profit margin by its total asset turnover to calculate that firm's total return on total assets, or their ROA. So again, the ROA is going to be equal to earnings available for common stockholders over sales times sales divided by total assets. So when we do the cross multiplication, we're going to take out sales completely when we cross multiply. So we're going to just take out sales, because when we cross multiply, those two will negate. So overall, we have earnings available for common stockholders divided by total assets. This is a figure in your textbook. It's kind of small to see here, but you can see where certain things are coming from, where we get to the return on common equity, the ROE, where they're getting the ROA from, and how they're coming about with that. So in the income statement, we have sales, we have cost of goods sold, we have the SGAs, other operating expenses, the interest expense, other income, and taxes. That's all coming from the income statement. With that, we can calculate the earnings available for common stockholders and the sales. And then with that, we take that earning and we divide it by sales to get our net profit margin, right? Then we can't move any further until we go to the balance sheet, where we have our current assets, our net fixed assets, our current liabilities, and our long-term debts. With the current assets and net fixed assets, if we add those two together, we get our total assets. And we take our sales and divide that by our total assets, we get our total asset turnover. Now with that, from those two statements, we can take our net profit margin, multiply it by our total asset turnover, and that's where we get our return on total assets, or ROA. With our liability side, if we add the current plus the long term, we're going to get our total liabilities. And if we add that to our stockholders' equity, we're going to get our total for those two sections to equal our total assets, right? Then what we're going to do is we're going to take that total, because it should be the same in the balance sheet. We're going to divide that by the common stock equity to get our financial leverage multiplier, or FLM. With that, we're going to multiply that by our ROA, and that's where we get our ROE, our return on common equity. So if we look at table 3.5 again, we're going to look at the ROA figures for IBM and Builders FirstSource. They are very similar in ROAs, with IBM earning 7.3 and Builders earning 7.2. But if you look at their net profit margins, by that measure, IBM is the far more profitable net company, with their net margin at 12.2% versus the 3.0% for Builders. So if IBM's net profit margin is so much greater, why did the two firms earn very similar ROAs? The answer lies in that total asset turnover. Builders turns its asset 2.4 times a year. It's much faster than IBM's asset turnover of 0.6 times. They use their assets roughly 4 more times efficiently than IBM does. But IBM's net profit margin is about 4 times as large as Builders. The end result is that similarity in the ROA. We can look at a modified DuPont formula. This is where we're going to relate the firm's return on total assets, their ROA, to its ROE, their return on equity, using the financial leverage multiplier that I just talked about, the FLM. This is where we're going to take total assets and we're going to divide that by common stock equity. It's the ratio of their total assets to its common stock equity. So again, oops, with that, we are going to take the ROE, the earnings available for common stockholders, divided by total assets, times total assets divided by common stock equity. Again, we're cross multiplying, so we're taking out total assets completely. So our ROE is then going to be earnings available for common stockholders divided by the common stock equity. So when we apply the DuPont system, the advantage of it is that it's going to allow the firms to break its return on equity into a profit on sales component, or the net profit margin, an efficiency of asset use component, or their total asset turnover, and the use of financial leverage component, their financial leverage multiplier, the FLM. So analysts can decompose the total return to owners into these important concepts. So in table 3.5, we saw Target's ROE was 27.7%, greater than the 18.5% ROE for Walmart. What are the drivers of that difference? If we look at figure 3.4 and move left, we can see that Target's ROA was 7.7, slightly above Walmart's ROA of 6.4. Target's FLM was 3.6 compared to Walmart's 2.9. So therefore, we know that the Target shareholders are enjoying a higher ROE because their underlying profitability, its ROA, was higher than Walmart's, and because Target used more leverage. Continuing in that figure, we are going to see that the ROA figure from Target's superior net profit margin of 4.2%, even though its asset turnover lagged Walmart's. So in this chapter, we looked at the components of financial statements. The Form 10K, which publicly owned corporations has to file with the SEC each year. It's going to document the firm's financial activities. It's going to include activities, strategies, and it's also going to include those financial statements, income statement, the balance sheet, the statement of stockholders' equity, or the statement of retained earnings, and the statement of cash flows. We also are going to see notes describing technical aspects of the financial statements that follow. Financial statements, cash flows are denominated in one or more foreign currencies, has to be translated into US dollars in accordance with the FAS standard number 52. We also looked at who uses financial ratios and how they use them. Ratios analysis, they enable stockholders, lenders, firms managers to evaluate that firm's financial performance, cross-sectional or time series basis. Benchmarking is popular for cross-sectional analysis, and users of ratios have to understand that the cautions that apply to their use. We also looked at ratios using to analyze the firm's liquidity and activity. When we took a look at Target, an analyst can assess the firm's liquidity or the ability to pay bills as they come due by calculating the current ratio and the quick ratio, or the acid test ratio. Those activity ratios measure the speed where those accounts are converted into sales or cash. They can use the inventory turnover ratio, the accounts receivable collection period, the average payment period for accounts payable, to assess whether the current assets and liabilities and where those are at. The total asset turnover ratio measures the efficiency where the firm uses its assets to generate sales. We also looked at the relationship between the debt and the financial leverage, as well as ratios used to analyze the firm's debt. So the more debt a firm is going to use, the greater the financial leverage, which is going to both magnify the risk and the return. Financial debt ratios measure both the degree of indebtedness and the ability to service debts. Common measure is the debt ratio. The times interest earned and fixed payment coverage ratios also measure the ability to pay fixed charges, like your leases. We also looked at ratios to analyze profitability and their market value. So the common size income statement shows each item as a percentage of sales. That can be used to determine gross profit margin, operating profit margin, as well as net profit margin. Other measures of profitability include the earnings per share, EPS, the return on total assets, ROA, and the return on common equity, ROE. Market ratios include the PE ratio, the price earnings ratio, and the MB ratio, the market book ratio. We also looked at a summary of financial ratios and how the DuPont system performs a complete ratio analysis for us. So the summary can be used to perform a complete analysis using both cross-sectional and time series analysis. And the DuPont system of analysis is a diagnostic tool that we can use to find key areas responsible for that financial performance. It helps the firm break the return on common equity into three components: the profit on sales, the efficiency of asset use, and the use of financial leverage. So this concludes chapter 3. So if you have any questions, again, please let me know, and we can go through them via email or through the office hours. It's very important, that you understand the concepts that we just went over in this chapter. We are going to start getting into heavier material now. So make sure you follow through in Moodle and make sure you complete the chapter questions. Again, if you need any help with those, please let me know. Remember to include a cover page so I know that it's your work. And again, if you have any questions, please feel free to reach out to me. I'm only here to help you guys. I wish you all the best. So here we go with the entire first week of the class. And again, let me know if you have any questions. Bye, guys.